Well, hello, everyone, and thanks for bearing with us. We're not that new to this, but we still have some tech hiccups here and there. I think one of the funny things that people don't understand, or maybe people do understand, there's a microphone setting at work, there's a microphone setting at home, and then there's a microphone on your laptop. It's like 3 different mics, and sometimes the default options get funny. So thanks for bearing with us. Yes, we are going to talk about the market. So we have August data already for you guys. So we're excited to share that. And then we're going to go into a couple different views or a couple different metrics. In fact, we're going to look at most of our major metrics. And we're going to break down some affordability questions, some questions you guys probably have about showings, maybe just in general, what's happening with the market, are things changing a little bit. So we're going to cover all that today. So thank you so much for joining us. We're really excited that you're here, and we hope you get something. We hope you get something out of it. As I like to say, here we are. We're drowning in information, and yet we're kind of still starving for wisdom, right? So this is just kind of our way of thinking through how can we impart some wisdom? How can we leverage our information and turn it into sort of real wisdom? Another phrase that we use is, of course, actionable intelligence. It's not enough to say prices rose X or sales fell X or days on market was flat at Y. What's important is the what, the why, right? It's beyond the what, it's the why. So how does this change how I talk to my clients? So how does this change whether I should get certified or credentialed in new construction or senior, or how does this change how I think about my business or how I target certain groups, age groups, areas, you name it. So that's kind of what this is all about. And I know you guys, most of you get that, but wanted to mention it. So 4 overarching trends, and these have been pretty consistent trends for some time, as most of you, again, know. So buyer activity is strong. Last year was a record-breaking year for sales. It looks like this year could still break that record, believe it or not, but we have a couple more months of data before we'll know that. Seller activity still weak because of a multitude of factors last year, including COVID. Sellers really weren't that eager. They weren't all that excited to list their properties. We do have some early signs that this could be changing, but we do have some work to do, obviously, on the supply side. Inventory, by far the biggest factor that's holding back sales and, of course, frustrating buyers. So active listings, or the number of homes for sale, it's declined 80% in 10, 11 years, while sales and population have only increased. So thus, at least as of a month or 2 ago, the market has sort of been bonkers, right? So home selling in record time at record high prices, and often for over list price, and at a record ratio of, I think we hit 104% and change of original list price. So clearly things have been, so I would say, absurdly strong. You might even say skewed. Things have been skewed, right? And I want to just keep talking about that skew idea. So let's talk about what's going on right now. So that's kind of the macro view. Let's talk a little bit more micro of what's happening kind of right now. So baselines matter. We're comparing against perhaps a more normal, we're comparing more normal 2021 figures against a skewed or especially strong 2020 market as a baseline. So that's not really a fair baseline, because activity was so high at that time and it's more normal now. And so you guys are going to see, sometimes we look at a 2-year change. Jackson and I have turned some of our weekly processes and weekly blog over. We did this a while ago, but we've turned it over to 2-year comparisons, just because comparing to 2020 isn't fair. It's not real. So just like I said here, that can mean sharp movement. And of course, it can result in skewed figures that just don't always represent reality. They don't always reflect sort of the true reality in the marketplace. Inventory, our chronic lack of supply, our ongoing shortage is continuing to pressure or suppress contained sales activity. So it's not necessarily that buyers suddenly lost interest as much as they have buyer frustration, right? I forgot to get my laser going. they have buyer frustration, right? They're feeling burnout. So buyer burnout, they have a wait and see attitude. They're wondering, will inventory increase? Will prices level out? Might rates stay this low, or might they creep higher? Will there be fewer buyers out there? Might I stand a chance? So these are some questions that are being asked from the buyer angle. And then what about your focus or specialty? Perhaps you focus on a segment or an area that's performed better or worse than the metro as a whole. New construction was doing better. It's changed a little bit. Condos were struggling. That's changed a little bit as well. And then some of the further out burbs and kind of far-flung areas and the satellite towns, as we say, did see an influx of activity. And then don't forget, 1 million plus has been on fire, and we'll see that. I do have some stats on that. Let us take a look at some short-term trends. All right. Daily showing activity, this is using our rolling weekly average. A lot of our data is monthly. This is not monthly, this is weekly. So we're looking at 2019 in light gray, 2020 in our dark gray, and then current year, 2021 in our dark blue here. We don't need to talk about what happened back here. I think it's pretty clear. You guys can kind of see what happened in 2020 and how 2021 has been well above that dip. And then it kind of converged with the prior 2 years, kind of after that area above that old curve kind of levels out here. Now we're kind of back to being on track with 2019. And that makes sense, you guys. Look at 2020, right? Look at 2020 in dark gray, clearly hovering well above any of the other 2 years for pretty much the entire back half of the year. Maybe we had a little bit of convergence here before Thanksgiving, maybe early November, but nothing too dramatic. So here we are sort of matched up. We're pretty well synced up with 2019, just sort of where the holiday falls. You guys can see different dips here based on the holiday, based on Labor Day and the 4th and Memorial Day. So we're kind of keeping pace with 2019. I think that's a fine thing. That's a good thing. 2019 was a pretty normal market. It wasn't skewed by a mad dash for homes, by people rethinking their rental or condo situation out of health concerns, or changing work patterns and changing commuting patterns or non-commuting patterns. So I don't think that's a bad thing. So just keep that in mind, you guys. We're on track with 2019. We are below 2020 because 2020 was so high. It's not that we're low now, it's that we were so high last year. So keep that in mind. I think some of you, based on what you're reading, you might think that this blue trend line would be way down here, right? That things are in free fall and oh my goodness, should I consider another career? No, that is not the case. It is up here with 2019. Okay, market share, right? Here's our pie, here's our slice of the pie. So I don't care how big the pie is. I care about our slice of the whole, right? Our share of the whole. So take a peek at this one. We've been watching this for a little over a year, right? 14 months, maybe 13, 14 months of these webinars. So share of overall showing activity, we have watched this segment absolutely evaporate. So this under 200K price point used to be 31.5% of all showings. It is now 17% of all showings. So basically chopped in half. Now, again, be careful here. Jackson and I have been using 2019 as our baseline because 2020, I don't want to say it's not real. It just wasn't sustainable. Maybe that's the way to think about it. It wasn't sustainable. It was skewed. So 2-year change. So over 2 years, this price point, showings in this price point, I should say, have been cut in half. Showings as a share of all showings have been chopped in half. We can see declines here as well, even in our 2 to 250 range. But then we have gains all the way up the price ladder. So once you hit 250, and up, you start to see these gains. It's really our most affordable segments where we see declines in showing activity. Don't forget, million plus, you guys. I know I've mentioned it once or twice, but 1.2 to 2.4 is just about a doubling in market share over 2 years. 2.46 may not seem like a lot, but the change, that's a pretty dramatic change when you think about it. Speaking of change in showing activity and the change being pretty extreme on the high end of the price spectrum, there you have it, right? Up 100% showings on listings between 6 and 800K, up 94% on showings at or above $1 million. And here again, the only place we see our declines in showing activity are on the most affordable product, the most affordable listings. So overall, over 2 years, right? Over 2 years, we're up 1%. Nothing too serious, but we're not down. And again, I think some people have this sense that we're down. Let me borrow from NAR. This is percent change in sales from a year ago. So this is prior year. So look at how we are mirroring the nation. We're following the trend nationally pretty well. So million plus nationally, by far the biggest gainer, again, at the national level, up almost 150%, followed by some of our other maybe luxury oriented or early luxury or move up or second move up market. You know, everybody has different names for these things. So you guys can see the most growth on the high end of the price spectrum. Okie dokie, new listing. So I know this is a fairly volatile chart with a lot of ups and downs, a lot of squiggly lines. So we're gonna smooth that out for you guys, but let's just stay here for just 20 seconds if you'll allow me. So new listings, here we are, 2021 in black. You guys can see we're actually pretty well synced up with 2018 and 19, right? We're kind of hanging in right there after the Labor Day holiday here. 2020, new listings, right? Pretty strong. Going to be hard to keep pace with that. Already, right? You can see we're down. We're down from 2020. We used to be way above 2020. Look at what happened with COVID here. Listings, 2020. So we were above and now we're below, and that may have more to do with last year than this year. So I hope you guys are sensing that's kind of a theme, kind of a trend. So let's be thinking about that. New listings, metro-wide. So this is our rolling weekly average, but we have used a polynomial smoothing trend line. Forget all those words. What we've done is we've smoothed out the trend. We have eliminated the volatility that you guys see here because it's rolling weekly data, right? So we see, you know, what is it? February. So here's Super Bowl, right? Here's the Super Bowl kind of influx. And then, you know, sort of some seasonal patterns, beginning of the week, end of the week, beginning of the month, so on and so forth. So we thought it would be valuable to really smooth out the trend. And I think this is just phenomenal. We think this is phenomenal for a couple of reasons. And we're not proud of ourselves. Well, maybe we are, but that's not it. It's just a phenomenal way to look at what's happened. And it's such a powerful way to talk about how this year differs from last year. And you can really see it, you guys. So new listings, take a peek at 2020 here in our sort of dark blue, current year in our darkest black here. So 2020, mid-March, we sure flattened that curve there. Not necessarily in a good way, the way we talk about flattening a curve around COVID. So look at the beginning of the year, 2020 new listings, seller activity was looking pretty strong. It may not look like much, but it was technically ahead, right? So that's a good thing. And then enter COVID, and that's what really flattened the curve. You can see, right? Ordinarily, it would have looked a lot more like that. Instead, it kind of looked like that. Because we lost activity here, we had to kind of make it up on the back end of the year. And that's exactly what we did. So you guys can kind of see that 2020 curve is really skewed toward the back half of the year. Here in 2021 in black, right here, the one that's not finished because the year's not done. Newsflash, you know, it looks much more normal. It's more in line with 2018 and 2019 in terms of sort of its distribution, but it is a little bit lower, probably because we borrowed some of that demand from this year into late last year and into early this year. You guys take a look at the black trend line early on, right? It was ahead of 18 and 19, and now it's a little bit below. And I think that's partly because we were borrowing demand, right, from last year, and that kind of continued. Maybe people felt pressured, like rates were going to change. Maybe people were concerned about Delta, wanted to make a change, you know, a lot of different reasons. Everybody has their own kind of reason. So pending sales, let's shift over to the demand side. And let me do a time check here. 216. All right, I think I have to pick up the pace a little bit. So pending sales, again, metro-wide, using our rolling weekly average, you guys can see 2021 started off pretty strong, right? And in most ways still is. So this year started pretty strong. has continued to hover above the prior years, especially when we see what COVID did to demand here in 2020. So here in black this year, we were hovering well above, and then we kind of got back on track. Right now, we're synced up. We're mirroring 2018 and 2019. Of course, we're below 2020 because look at 2020. It was skewed, right? It was pushed higher by the multitude of factors, some of which we've mentioned already. So again, is this truly a fair comparison? Well, I guess we've been doing year-over-year comparisons for decades, so we can do year-over-year comparisons, but it's just not really apples to apples. It's just not really, it's not really a reasonable comparison. So let's do our same little trick. Yes, I love this one. We're going to do our same smoothing trick. So here we are. You guys can see 2020. Wow, look at the skew there. Look at how much activity was back weighted, weighted on, again, that back half of the year, right? You can't make this stuff up, you guys. Right there in June, we really started tilting back toward the third and fourth quarters. So we can see here in 2021, we looked pretty strong. We have been strong in a lot of ways. We still are. That hasn't really changed that much, but we were above those prior 3 years for pretty much the first half of this year. It's not that we've fallen below 18 and 19, it's that 2020 has surpassed us. So I'll say it again, the decline in sales today has more to do with what happened last year than what's happening this year. I hope that makes sense. I think it does. I know you guys get that. I know it's just a little wonky to convey to your buyers or your sellers, right? Who might be saying, oh no, Mr. and Mrs. Agent, I saw something in the news and now it's not time to sell my home anymore, right? Or it's not time to write an offer. Well, you're seeing in the news that black is lower than this dark blue, but you're not hearing that it's actually above the prior 2 or 3 more normal years. And it's a little bit of a complex trend that takes some explaining. You guys will get these visuals. We will be sending out the PowerPoint. So feel free to use it, right? This is your data, use it to grow your business and get referrals and repeat buyers and whatnot. So what a powerful trend, just a powerful visual to see just how much last year was weighted toward the back half of the year. And that is affecting our year-over-year comparisons today, this year, this month. All right, let's speed through this one. So we already kind of looked at this change in market activity by price range. Again, we won't spend a lot of time here. Just know that we're looking at change in new listings in gray and then change in pending sales in blue. Of course, our most affordable ranges, both sales and listings are down. No surprise. Here's what's interesting. Look at pending sales in blue, outpacing growth in gray. In every single price point above $250,000. Let me rephrase that. Demand growth is outpacing supply growth in every single price range over $250K. One more time, growth in demand is exceeding or outpacing growth in supply in every one of our price ranges over $250,000, especially in our luxury segments. All right, let us shift gears into some longer term trends. Price reduction analysis, everybody's favorite, right? Hang on, Carissa, do you predict the line will continue to fall for the rest of the year? Let's hop back here. Let's see, what time was that asked? I can't, 2:16, so we're 2:21. So I think you were maybe talking about, well, let's address both of them. New listings, a couple things going on here. I don't want to get too far off time. If people sense that the market is changing and that they might be missing their opportunity, right, they start to catch the disease of FOMO. I have a fear of missing out on the peak of the market. Does that force me, I should say, does that encourage or incentivize me to put my home on the market so I can take advantage of peak pricing? Maybe. I can see some people doing that. How about forbearance? People are coming off forbearance. A lot of these folks are on payment plans. There's not even close to as many foreclosures will hit the market as we saw back in 2008, not even a fraction. And even if we do have a couple thousand or tens of thousands, guess what? We're so thirsty for the demand. Tens of thousands is totally unreasonable. Hundreds or even a couple thousand. We're so thirsty for supply that it just won't blow up the market the way it did in 08 and 09. So I don't know, a couple factors going on there. I would at least expect this trend to mimic 18 and 19. But I guess my gut says that we could end up a little bit over here. I would think we'd be kind of between for the factors, because of the factors that I mentioned. On the sales side, the only reason we're seeing this little up clip here, this uptrend, is because we're not done with the year. And we have seen a little bit of increase on a daily. Remember, this is a daily and weekly average, not monthly numbers. So this didn't show up in our July and may not show up in our August report, actually. But remember, this little trend is pulling from daily and weekly data. It's still below 2020, so it's still down year over year. However, right, it could be showing some upswing, for the time being. As the time goes on, obviously, we're gonna have more data to base that on. So it's gonna be a better trend line. It's gonna be more representative. I would think we kind of stay again in between 2020 and 18 and 19 here. I would think we kind of smooth out and look a little bit more like that. Again, if we don't have the inventory, I can't write the offers, right? It is that simple. If I don't have listings to write offers on, I can't write offers. So obviously that's a factor too. Percentage of sales with a price reduction. And thank you for the question, Carissa. Percentage of sales with a price reduction. Yes. 51% of closings in 09 required a price adjustment, over half, right? It stayed at just about half for just about 4 years, when we were kind of in the deep, dark depths of the Great Recession there. And then things changed a lot. Only 40, then only 37, then only 30, and now only about 25%. Last year, only about 25% of sales had a price reduction. So, the trend is really clear here, right? We can see the market kind of weakening when we had more price reductions in order to attract a buyer. And then as the market's heated up, right, I don't have to make these concessions nearly as much. Sometimes if I'm overpriced, right, this doesn't always reflect the fact that buyers aren't willing to, it doesn't reflect that buyers aren't willing to buy homes. It reflects the fact that when you listed at 350, you really should have been at 324.9, right? So sometimes that requires an adjustment, obviously. Okay, so here we go. We have gone through August of 2021. So just last month, 17.25%, right? So I'm not seeing any increases here. I'm not seeing anything alarming. We're going to keep watching it. September could be different. October and November could be different. So we're going to keep watching that, but I don't see any major turnaround here. Very similar trend, right? From 30 up to 50, back down to 30, and now we're down to 21 and 17. So only 17% of all sales last month required a price reduction. Okay, enough of that. Let's dive into our major metrics, our main ones, the big dogs, everything you'll see in our monthly indicators, and so on. New listings, August. Let's take a look.
Just a heads up, David, we got about 30 minutes left.
Perfect. Thank you. Sometimes that lights a fire under me, and I don't want to rush. All the data is so important. So August new listings, you guys, down 3.6%, right? We were up about 3% last year, 77.20. Now we're at 76.40. So that's pretty flat, you guys. In fact, it's been pretty flat for years. Some of you may be thinking, oh, okay, well, at least we're not losing sellers, at least not really. But I'm thinking it's unacceptable, right? It's just not where it needs to be. Now, that's probably maybe a little bit high because some of those were condos or, projects that didn't always come to fruition. And that was kind of a supply-driven bubble. But I think we belong at least 85, if not 995. And the only reason I would say that maybe we should be approaching 10 is because we've had population growth, right? And we've had job growth, population growth since then. So maybe we do need to be closer to that level. Pendings, here is some volatility. Here's where you see down 10%. Oh my God, pending sales are down 10.3%. I can see it in the Star Tribune right now. Sales in the region crash, plummet 10.3%, right? Yes, technically that is the percent change. However, what it leaves out is the fact that we are above 2019 levels, right? 6,000 to 6,500. So that's what, almost 10% growth over 2 years, about 4 or 5% a year. I think that's just fine. But look, guys, we were up 21.25% last August, right? That was not sustainable. That was the highest August pending sales figure in 18 years, right? All the way back to 03. It's not that it wasn't real. It was real. It happened, but it was so skewed, and it was due to something. It had a catalyst, right? COVID and other factors. So now, yeah, we came down from that sort of pie in the sky, but we are still growing, right, over the last 2 years. So again, it's really easy to look at this minus 10% and really latch onto it and start to think negatively and start to talk pretty negatively. But the truth is, it looks extreme just because of this. So again, down 10% has very little to do with current activity. Down 10% has everything to do with what happened last year. I hope that makes sense, guys. I think it's so important. I mean, what a visual to show buyers and sellers to say, you know, a seller saying, you know, I think we're just going to hold off. We'll see what happens next spring. You know, well, buyers are out there, right? Buyers are out there. They just need inventory, and they need rates to remain friendly, which they are. But buyers aren't disappearing. They're not gone. Closings up 0.6% to about 6,900. You guys can see pretty steady growth here. We saw a lot of volatility here as a lot of those contracts, of course, hit the closing table, and our title folks and our closing friends, you know, obviously saw that. But lately, pretty stable growth. CDOM, cumulative days on market. This is the median. 10 days signifies what? Half the listings took over 10 days to go under contract. The other half of the listings took under 10 days or went under contract in fewer than 10 days. Well, let's just geek out on that for 1 second. 100, right? Almost 100 days. Market times have come down 90% since 08, right? 90% since 08. Homes are selling in 1/10 the time, 10 days versus about 100 days. Median sales price. Let's make dollars out of the cents and make cents out of the dollars, or whatever it is. So August median sales price up 11% to 350. We've been pretty stable at 350 for some time. Last August was almost 10%, got us to 315. Our previous peak is 235, seen back in 06. You guys can see, you know, we kind of hit that back in 2016, and we've been stomping ever higher since. I see acceleration, 6.5, 7, 10, 11. I see some acceleration. That was year over year. Let's look at monthly. This is why we have to use these different metrics and different visuals to give us the true sense, the best sense of what's happening. So based on, let me go back one, based on this, you guys, right? We just looked at it, 6.5, 7, 10, 11. Looks like price growth is accelerating, but that's just for August. This is for every month of every year going back to January of 04. This is why this is so glorious. This is why we need multiple tools in our toolbox, or weapons in our war chest. No, let's go tools in our toolbox. No violence, please. So, right. So we did see some acceleration, to be sure, in price growth. You know, guys, let me zoom in for you a little bit. We definitely saw appreciation. We definitely saw acceleration. Well, both. We saw acceleration here. So prices were growing at, you know, not quite 10%, maybe 6 to 8, you know, call it 5 to 10. Suddenly they were over 10% reliably for 1, 2, 3, 4, 5, 6, 7, 8, 11, 12, 13, 14 months, right? And so here we kind of maxed out at 16.5%, which was really close to that as we were getting out of the recession, it was really close to that figure. But actually, I do see price growth moderating, decelerating, not going backwards. Prices are not falling. They're growing at 11% instead of growing at 16%. We're on the highway. Our car is going 50 miles an hour instead of 70 miles an hour. We're not in reverse. We're not slowing down, right? So, based on this visual, price growth is still going strong, but perhaps it's not accelerating in the way that the previous graph might have some believe. PPSF, some of you know that I like this chart. Maybe all of you know that I like this chart. It does a couple things. First of all, it normalizes for size. Listen, if we have bigger homes selling, bigger homes tend to cost more money. So bigger homes selling tend to drive prices higher. What price per square foot does is it normalizes by that. It controls for square footage. It says, let's take that sales price, but let's divide out by the square footage. So we're actually looking at a true price per foot measure. I don't care how many of those feet you have, 800, 1,800, 8,000. We care what buyers are offering and what sellers are accepting for that 1 square foot of house. And sure enough, just about $180 per foot. So $180 multiplied through by a 2,000 square foot house gets you to about 360 grand. Maybe that seems like a lot for a 2,000 square foot house, especially considering the fact that that same 2,000 square foot house, would have cost right under 200,000, not all that long ago. Teresa, is that great question. So this is total finished square footage. So TFSF coming straight from Matrix, straight from the North Star system there. Good question. I like that. A methodological questions on methodology. I also like saying methodological. All right, percentage of original list price received at sale. So August percent of your original list price that the seller is accepting at the closing table at the time of sale. 102.5%, up 2% from 103% last August, right? That's a pretty strong number, right? That's a pretty strong number. It has come down from 104%. I think we were 104 and change. So it is not as high as it was, a few months ago, but it is still over 100%. And that is still just a kind of an insane metric. The fact that it's been over 100% for 2 years, well, 2 straight Augusts anyway. So at least a year is really pretty remarkable. Even during the bubble, right? We were not really even over 99. We didn't even really surpass 99%. And then we went down to 91. And again, we have stomped up to 104. Now we're about 102, 102.4. Interestingly, you guys can see maybe we were starting to level off a little bit in the BC era before COVID, right? But then in the AC era after COVID, kind of reaccelerated and our inventory crisis worsened. We had a great shuffle. People were thinking about rentals and condos a little bit differently. Again, some evidence that's changing, but we know all those dynamics were at play. August inventory, we have plenty of it, so we don't have to talk about it. Gulp. Yeah, right. We got to talk about it. So the number of active listings, number of homes for sale, inventory, properties on the market, all synonyms, all synonymous, right? So 36,500 active listings in August of 07, 36,500 down to 7,600, 7,700, right? That is a change. That is a shift. You guys can see we kind of flattened out a little bit for a few years, and then buyer activity has just been overwhelming sellers. And we saw, right, throughout most price points, demand growth has been far exceeding or outpacing supply growth. When buyers are more motivated than sellers, right, it's hard to keep inventory on the market. In fact, there's a couple people have theories that given this market, maybe some of the, how do I say it diplomatically, very, very affordable, perhaps needs work, very, very entry level, first time home buyer type product, some of those products that wouldn't ordinarily sell in any market but this one, maybe we start to see some of those because people want to take advantage, because there's so little out there, there's so few options out there, that maybe I am willing to live through a construction project. Maybe I am willing to put in some sweat equity and redo a bathroom or think about a kitchen or whatever. So I always thought that was kind of an interesting idea. Okay, month supply of inventory, 10.4 to 1.4. Can't make this stuff up, guys. We lost 9 months of supply, right? Since 08. So back here, we were oversupplied, right? Over 10 months of supply. Here, we are well undersupplied. In fact, anything under 5 months of supply, you're technically, right, in a seller's market. You're relatively undersupplied. So 1.4, we are definitely in undersupplied territory. I think most of you have seen this. We've shown this for several months now. I won't go through all of it. I know sometimes this can be a challenge to understand, or even if you do have a mastery of it and a great grasp of it, sometimes just the visuals can be helpful. So seller's market, you've got a lot of buyers competing over only one listing. Buyer's market, just the opposite. You've got 3 sellers, but they all have to make concessions and compete with each other and price reduce in order to attract or lure in a pretty small pool of buyers. We want a balanced market where we've got 5-6 months of supply, where 4 units of supply are pretty well matched up with 4 units of demand. Year to date, you guys, I know, we're past the midpoint of the year. We've technically got the majority, not by much, we got the majority of the stats in for the year. So let's look at new listings, up 1.7%. I don't know if we'll end the year, higher or lower than that. Maybe just about that. Very hard to predict, but on a year-to-date basis, actually seller activity is up for the year. Pendings, we just saw pendings were down 10.3% from a uniquely high and skewed baseline. For the year so far, up 4.5%. We'll have to see how we end up, but 46.39 versus 44.6. So far, this is the second strongest start to the year or year-to-date period so far of any year, of any year-to-date period of any year, going back to 03 with the exception of 05. Let me start over. The 2021 year-to-date has more pending sales than any year-to-date period except 05. And that record goes all the way back to 03. How's that? I think I did better the second time. All right, closed sales up 8 1/3%, 43,000. And actually that is a record high, right? 43.1. That is a record high for August year to date, going all the way back to 2003. Yes, some deep dives. Let's quick time check. We are at, what are we, 40?
Yeah, you got about 15 minutes left, David.
240, okay. 15, are we cutting me off at 55 nowadays?
I mean, I wanted to make sure there were times for questions in case people needed them. So
I suppose.
Just hoping you got the 5 minutes if you really need it.
Okay, we'll do a check-in here. Okay, so you guys have seen this one. We keep updating this every month straight from North Star data. We call this one our disappearing act. So what share of our active listings are under $250,000? Some think of that as affordable. Some think of 300K as that sort of affordability marker. Anything under 350 nowadays might be considered relatively affordable. So it's funny how that bar kind of keeps moving. However, if we feel bad about that, let's just look at New York, California, and Florida, and we'll feel a little bit less bad. So metro-wide, 23%. Minneapolis, a little bit of an uptick in terms of affordable active listings. Maybe what I was talking about could be coming true. Some of that more affordable product that needs a little bit of work, pretty toward the low end of the price continuum. Maybe you see some of that coming on in hopes of getting an offer because they may not get good enough offers in any market other than this one. Our friends in St. Paul, 52%, they've been flat. So they've been hanging on to some of their affordable units, down a little bit, but this trend in Minneapolis is pretty interesting. And the metro has also flattened out a little bit. It would be nice to see some increases, but we want to see increases because of new production, not because of price declines. Great mean reversion, right? Prices aren't really all that high or out of control. They're just kind of catching up to where they ought to be. All the way back to 1960. This predates Jackson and I by a couple decades. You guys can see, right? Look at the run up in prices, right? Into the bubble, 05, 06, right here. You can see prices getting a little bubbly. You can also see the downturn, and then you can see the recovery that we've been on and kind of getting back to, well, what about nowadays can we call normalcy, but maybe getting back toward typical growth or growth that's consistent with, historical trends. So I've put sort of an upper and lower bound on this, 5.5 and 5 1/3. Just know that in this channel, this is sort of the long-term growth rate. Sometimes the growth rate has been above average. Sometimes the growth rate's been negative and below average. And what do you guys notice here? We're actually not even back in that channel. So that, look at how high above that upper threshold we were, right? This was pretty bubbly. We should have noticed that. I wasn't in my current role then, so don't throw tomatoes at me. But, something was happening here very clearly. And so, no, we're not even back in that channel. So I believe this chart suggests that we're not really that overvalued, if at all. In fact, you could make an argument that we're undervalued given that long-term trend. Now, I don't want you to go and tell sellers that we're undervalued and that they should price their properties even higher. However, what's important to understand, I think, is we have some room to run. We have some runway ahead of us. So we're not going to, be slamming against a brick wall anytime. Well, not quite yet. Market activity, new listings and closed sales, this time going back to 1967. We have paged through some of our old 3-ring binders with our old data. So look, you guys, look at new listings and sales. Look at this run up in supply while demand was falling. Of course, prices had to decline, right? Of course, the market had to soften. What do you guys notice here? Supply and demand are as tight as they've been since 1967, right? Maybe with the exception of, a couple times in the late 90s here, but supply and demand are just about as tight as they've been in decades. This smells like a bubble, right? This smells like a bubble. This even sort of smells like a bubble. This does not smell like a bubble. It doesn't look like a bubble. It doesn't smell like a bubble. It doesn't quack like a bubble. It doesn't do all the other things. It's not bubbly. It's not a bubbly thing. Urban market share. What's happening in our cities, folks? Let's take a look at the percentage of metro-wide sales occurring in either one of our beautiful core cities. We had this back to the city movement, right? This urban renaissance of sorts where people wanted to move back to condos and back to the city. And what reminder do I have? Oop, I got a meeting coming up. That's okay. They know I'll be late. So we had people going back to the city. We had condos. We had all this fun stuff downtown. All of it's still there, right? Bridgewater, Carlisle, Skyscape, Grant Park, all of it's still there. All the conversions in the North Loop, 701, 901, 801, 712, 711, all that stuff. And then we declined, right? We kind of declined. Once that condo bubble kind of burst and the housing bubble burst, we saw activity kind of pick up in the suburbs and we saw urban market share decline. Look at April of last year. After COVID hit, and here you guys, let me do my little trick here. After COVID hit in April, we saw market share kind of fall, right? More than it would kind of seasonally. And then what did we see? I don't think people understand this or are aware of this. We've actually seen urban market share growing for many, many months, right? After COVID. I'll say that again. We see a larger share of metro-wide sales occurring in either Minneapolis or St. Paul, right, than in the past. So we actually see growth here. Maybe that's because of price movement. Maybe that's because people are going back to condos after we did see heightened listing activity and some heightened activity last year. Multitude of factors, but we are seeing growth in our urban markets. All right, let's keep speeding along here. Luxury. Now there's a wine cellar for the ages. Luxury, $1 million+ monthly. What's happening with sales at or above $1 million? region wide up 51%, right? From 110 to 166. We have over 100 more million plus deals closing per month than we did in 06. One more time. We have over 100 more deals closing above $1 million per month than we did in 06, right? That's pretty dramatic. You guys can see, right? This luxury segment has absolutely taken off. I heard just last night on NPR, what was it? More billionaires were created last year. Oh, shoot, I can't remember the baseline. I don't think it was ever, but I think it was at least in decades. So, you know, those at the top were doing pretty well last year. And those with the financial wherewithal to do so decided to upgrade their living situation. More room for a home office, home classroom, a little bit more outdoor space, because we need outdoor space because we're not going to the movies or bars or restaurants as much, or sporting events, whatever. So again, a lot of factors going on here, but the takeaway, luxury is high flying, doing pretty well. All right, so just a couple thoughts in terms of the broader outlook. Caveat, disclaimer, I am not an immunologist, virologist, or epidemiologist. I think I got all of those right. What I am is a guy who knows how to produce and read charts. So first wave of COVID, second wave of COVID, third wave, Delta, right? Delta. I don't want to say, no one can say we're past the peak. Nobody can, and nobody should say that. However, I do see a little bit of a leveling off. You know, then again, we said that here and look what happened. And we said that here and look what happened. However, you know, we haven't seen any kind of ease up yet. This is the first ease up. Hopefully, you know, we kind of see this, but we just don't know. So obviously this is an unknown. This impacts jobs, the economy, rates, monetary policy, fiscal policy, consumer confidence. It really does ripple throughout a lot of different sectors and sort of corners of the economy. That includes residential and commercial real estate, of course. Appraisal gaps. I know a lot of you have told us about appraisal gap clauses where, you know, if the contract is 300,000, it appraises for 285. I got to bring the 15 grand to the closing table to fill that appraisal gap. So this, forgive me guys, I only could find this through May of this year, but if you look, right, the prevalence has more than doubled. In fact, it's almost tripled since May of last year, right? 7 to 21 would be tripling. So just about tripled. 1 in 5. This is national, you guys. So be careful here. This is national. Again, I have to think that California and Washington State and New York and, you know, Massachusetts are, and Miami, you know, a lot of these different areas are skewing this higher. I don't have data locally. I would guess we're not quite that high, but I know it's higher than it's been, probably higher than it's ever been. This is from the JCHS, Joint Center on Housing Studies from Harvard. I think those guys are kind of smart. So let's just take a look. Declining interest rates have offset the rise in home prices, right? Preventing a sharp increase in the real monthly cost of home ownership. Let's take a look. Blue, median sales price. So here's our sales price in blue. Mortgage interest rate. Here's our interest rate in kind of light blue. And there's your monthly homeowner housing costs in green, right? Yes, prices are rising, but declining interest rates have offset that so that monthly payments actually haven't risen that much, right? We've been saying this for years and years. We're in a monthly payment business, right? Median sales price only matters to the 9% of Twin citizens that pay cash for their homes. The other 91, 92+% of us use this thing called a mortgage, and that makes it a monthly payment business, right? So I love how this captures the fact that yes, prices are high and rising and as high as they've ever been. Interest rates are low and I guess kind of declining-ish or low and maybe stable-ish, which means that the monthly costs have been flat, right? Come up a little bit, but it's actually below the peak, which is kind of remarkable and maybe a surprise, even a shock to some. All right, keep trucking here. Average number of offers received on the most recent closed sale, 5 offers, right? Again, that goes back to March. But if you look at 17, right, just look at how much this has changed. I know that's a little bit dated. I've looked for, through July or August. I think it's going to take a couple more months to do that. So watch for that in the future. All right, existing home sales, you guys. This is again from NAR. This is national at a seasonally adjusted annualized rate. So let's take a look at this. Right. So March 2020, April 2020, we saw this huge decline. And then we made up for it with this huge gain. Right. And now in our year over year comparisons, it looks like we're down. I've put this arrow in because look at this trend here, just here. Is there a possibility that this trend just kind of continues? Right? Can you kind of see that? It's like a heartbeat. It kind of goes right way down and then way up and then kind of gets back online. I should say back on track, back on trend. So, maybe that's reading a little bit too much into the tea leaves, but, people think the world is ending down here. People think they're on top of the world here. And the reality is these are sort of fleeting and temporal trends, right? Just a thought, not a guarantee, just a thought. So housing market index, or the HMI, has come down a little bit, but here again, right, it was way down and then it was kind of way up. So maybe we can just kind of squint and turn our heads to the side and say, maybe there is an overarching trend here. Light vehicle sales down. Why are you a realtor looking at light vehicle sales? It's a really good indicator for the economy. These are consumers buying cars. Couple factors here. One, gas prices. 2, how about shortage of vehicles, shortage of chips, driving a lot less, telecommuting, all these other things. But look at what happened. You guys can really see the impact of COVID here. Look at that decline. That was a really good indicator that retail sales would fall, right? Consumer confidence would fall, and everything else that would follow. Vehicles are a durable good, right? Kind of a longer term good, not like a dinner out or a movie theater ticket. I won't go through all this. Just know, of course, loan amount, mortgage rates, as mortgage rates increase, in order to keep your payment the same, the price has to fall a little bit. Now, rates are still, what are we at? 2.8, 2.9. They're still really friendly, really attractive. But just keep in mind, as rates creep up, and I'm not saying they're gonna immediately or even this year or maybe later next year, maybe middle or late next year, we'll start to see some normalization. I think we'll be under 4% for some time. So I thought this was a handy table for you guys. Lumber, I talked about the shortage of chips in cars, and there's a shortage in appliances. And look at what happened to lumber prices. 2 years ago, I paid $8.99 for a 4x4 sheet of OSB. It's the kind of pressed strand board. They do a lot of roof decking and siding with it. This year, I paid $57 for the same handy panel, little 4x4 sheet of OSB. God, why didn't I wait a little bit to do that project? Look at how much it's come down. So it really shot higher. We alleviated some of those supply constraints. Our logger, our friends in the logging community, must have really picked up their pace. And sure enough, we've seen lumber prices come down. Forecast, most folks, earlier this year were thinking maybe 5 1/3. Looks like now they're thinking more like 7.5, 7 3/4. In the coming months, there's a possibility that could change. So do check back. Just kind of as we close up, you guys, seller activity is up, but we're comparing to I should say buyer activity is down, but that's compared to a pretty high kind of baseline. So prices are up. Here's another interesting part. We just saw million plus is up. So maybe not every home is worth 11% more. Maybe we just have more 1 million plus product selling, or more 500K product selling, or more new construction selling, or more larger home selling. So, it's not that every home is worth 10, 11% more year in and year out. It's that the cross section of homes can sometimes change a little bit. All right. I want to do just a few applications. I know we're just about at time here. So how do we use this to answer questions? Are we in a buyer's market or a seller's market? Month supply of inventory can answer that question. Prices rising or falling, median sales price can answer that question. How long will it take to sell my home? How much of my asking price will I receive? What's happening in different segments? All of it's there. You guys get to be the expert that you wish to see in the market. How else is this going to benefit me? Listing presentations, open houses or showings, right? Lead gen. Maybe you want to say your market time is 28 days, while the overall market time in Woodbury or Edina or Plymouth is, 52 days. There's so many different ways you guys can use this and leverage this to grow your business. Those are just a few. And with that, I'm going to stop in the name of love and open it up to maybe one or two questions. Anybody at all?
I don't see any questions yet in either the Q&A or in chat. We'll definitely hang around for just a minute or so. There are still about 15 or so people in the pews, if you will.
In the pews, I like that. Bleachers?
The bleachers, I guess. Yeah.
The bleachers, I like that.
Yeah.
It's good.
All right.
Maybe one other thought. I mean, if you guys, maybe next time throw what you guys want to see. Are we missing anything? Is there anything else you want to see that would help you in your business? So we also would love feedback if you have any. So shoot us a note, an email, give us a call, or, submit something. And yes, Teresa, you will be getting the slides.
All right, everybody. Thank you so much. David, thank you again. You always give such a great presentation. We're happy to have you here. And thank you to those who attended this monthly housing market update. We'll see you in October.
Thanks, Jackson. Thanks, everybody. See you next time.